In value investing, there's one concept that is very important. It's called Mr. Market. I think for most people, if you read some books about investing and you will understand what is Mr. Market mean. But if you are new to value investing, then Mr. Market is a concept created by investor Benjamin Graham, and he's Warren Buffett's professor. And I think Mr. Market is very important for investor, but not for trader or short-term, buy and sell people. Why I think Mr. Market is so important? Because as a human being, when you look at the stock price, most likely you just cannot detach the price from the investment. Because when you look at the price, when the price goes up or when the price drops, most likely you cannot control your emotions. For example, yesterday I talked about TD Bank and the Royal Bank. This is the financial analysis report provided by BMO Bank. It's free to everyone. Yesterday, I talked about the PE ratio. I said, actually today, according to the valuation, TD and the Royal Bank actually is 10% cheaper compared to last year, which means a year ago, last year. So they are still at a reasonable 10 years average price. But if you look at here, the upside scenario and the downside scenario, this is for TD, okay? So the BMO analyst, the professional, they give a price range, which is maybe 28% more or 32% downside. What does it mean? This means the stock price maybe go up 28% in the coming 1 year time, next 1 year, or it may go down. It may go down like 32%. So basically, it tells you, say, the stock price today, the stock price is 78, then in 1 year time, it maybe go up to $100 or drops to $54. So what's the heck about this? Let's see. How can this company, in 1 year, the price change can be more than 50%? Why? And if you look at it, it was a Royal Bank here, and this is TD. If you look at a TD, this is actually TD. I think I selected wrong report. Okay, yeah, just let's use TD as an example. So the professional investor, in their analysis report, they think the price maybe can go up to $100 or drop to $54. So the upside is almost the double price and the downside. This is exactly what Mr. Market concept tells you what will happen. In 2011, Warren Buffett made a speech in India. He said, if you look at the typical stock price on New York Stock Exchange, its high will be perhaps for the last 12 months will be 150% of its low, so they are romping all over the place. All you have to do is sit there and wait until something is really attractive that you understand. There is almost nothing where the game is stacked more in your favor like the stock market. What happens is people start listening to everybody talk on television or whatever it may be, or read the paper, and they take what is a fundamental advantage and take it into a disadvantage. There is no easier game than stocks. You have to be sure you don't play it too often. I want to repeat this. There is no easier game than stocks. Sometimes people ask me, why don't you invest in real estate, especially in GTA where I live? You know, in the past 10 years, the real estate is performing extremely well. But you know what? To me, I only want to play in the easier game. Okay, the easiest game is to me is the stock market, because Warren Buffett, from his experience, he told me, he teach me, there is no easier game than stocks. So I want to play the easiest game. And let's go back. This is exactly from $54 to $100. This is exactly what Warren Buffett is talking about. And this is I copied it from the internet. Someone posted. Okay, so if you look at here, this is the top 10 largest companies in states, and in 2016, the average price change is almost 50%. So if you look at the TD stock chart, let's say select 1 year. It's from $67 to almost $79. Okay. If you select 5 years, you can see from 2016 to the year end, I think it's up more than 30%. Again, 2014, less than 1 year is $50 to is another 30%. When people talk to me about investing, they always say, "Oh yeah, you know, 7 years ago when you started to talk to us about TD, we should listen to you. We should purchase more TD stocks because 7 years ago is less than like $37 or $38. So today the price is more than double, and if you include the dividend reinvest, is or more than like 150% total return." Well, if the person who missed the opportunity, let's say 7 years ago, 5 years ago, 4 years ago, so what he can do? Well, if you really study the value investing and pay attention to the missed market concept, then you have one opportunity you can think about. Because in every year, the TD stock, the high and the low, there's a 30% difference. It's 30% on average every year. So let's see, if I purchase the TD stock today, and then 1 year later, if it's 30% more, the price will go up 30%. If I sell 50% of my holdings, then My capital, investment is like the average price is only like 50% of the current price. What that means is like if I purchased the stocks like 1 year ago is 64 and today is almost 69. If I sell 50% of my holdings, then I have a $15 profit. So average down your the rest of your holding, the cost is only less than $50 if you're including uh, the dividend. So let me ask the question: if today TD stock price is 79 and your average cost is only $50, how you think about it? The price, if the price drop 25% from today, you still make money. You still make a lot of money. How you feel that? Obviously, to most average investors, you feel comfortable. Then I want to tell you this kind of opportunity in the market every year for almost 100 years. So you have the opportunity every year for 100 years, no matter which year you start to invest. So you have opportunity every year, and you have opportunity no matter when you start. If you understand the missed market concept and apply to your investing process. Also, this is one reason why I personally prefer a concentrate portfolio, because it's not necessary uh, to look at too many stocks. Because if I apply all the value investing principle properly, I can make enough money, and also I can make very decent return. Here, $54 to $100 is 100% return in 1 year. Obviously, it's very difficult to get 100%, but to get 20-30% a year, it is possible. One reason I like this Mr. Market, actually I really want to apply the Mr. Market concept into my investing process. It's very simple. For example, for TD stocks, in 2016 January, because the oil price crisis, the price dropped to under $50. And today, if you look at the 2017, it's up more than 35%. So in 1 year, it's up more than 35%. I already know the TD, the business, enough to understand the long-term potential. And when the market gave me the opportunity from $50 up to $67. So basically what happened is, if I purchase TD stocks at $50 and I sell 50% of my holdings, then my average cost will be only $30. And today, another 1.5 years later, it's almost $79. And my average cost is still under $30. So if the market crash, and the stock price crashed and dropped more than 50%, I still make a lot of money. And this opportunity just happened 2 years ago. And it also happened 4 years ago. In 2013, the price from 44 to 57. This is exactly repeated the whole process because at the time was people worried about the interest rate. And this is all the mixed market concept try to explain. If you look at it here, the mixed market will offer you a chance to buy low and sell high. So in value investing, if you understand and accept, I think sometimes understand is not enough. You have to accept it. If you accept the mixed market concept, and you will find more than enough opportunities for you. I mean, because you are a small investor, you only have a couple of $1 million, maybe less than $1 million capital. So you will find a lot of good opportunities every year. So you can start anytime, and you will have a very good opportunity.